Oh, this is Charles. And vertical option spreads, 1.8 standard deviation inflection point. Today, what I wanted to do is to deviate a little bit from trading systems and actually covering calls and puts and spreads and whatever. And I want to talk to you a little bit about the inputs to the spreadsheet and one of the most critical assumptions that we all have to make as option and spread traders, much less traders of any type. So just for the first minute or two, I'm going to go back to the basic model of the trading spreadsheet that you have. Annual return, we're focusing on the assumptions, and then I'm going to go into some data, and eventually the purpose of this 30-minute discussion is going to be on volatility and what I call the amazing spreadsheet, which is available to you, and I'll show you before the end of the lesson. It's under Resources, third spreadsheet tab down. Annual return. Let's go up to cell C1. Annual return is your best estimate based on however you're coming up with it, fundamental or technical analysis or Ouija board or whatever it might be. And you are effectively saying that I think an asset's going up at, over the next year, 10%, the capital gain, going from 100 to 110, the stock price. Or I think it's going down to 10%, from 100 down to 90. Whatever that might be, you need to input that as the annual rate, and it'll be adjusted for by whatever time you put in here. So over 5 days, of course, 10% is going to be virtually nothing. But if you put in 365 days, obviously the Brownian model will then pretty much tend toward an expected average of up 10%. And you change that with this tab right here. And you've seen this before, but I'm just pointing it out. So if you think the asset's going up at 20% annually, you would put a 20 right there. And if you think it's going down 10%, well, then we would shift it down using the spinner until finally it showed a negative 10%. And I think you get the idea. Generally, as I had mentioned, you usually leave it flat for my own trading, simply because I think that I don't have any idea where it's going in the next 5 days, or my guess is as good as the market's. How's that? Skipping historical volatility. Let's jump down to price. Well, price is self-evident. The price is, when you put in a trade, what is the stock price? SPY closed at 179 just the other day, so if you set this down to 179, which you can see I'm getting to little by little here, then clearly my price is set. The price is what it is when I go into the trade. Implied volatility is basically set by the market. So when we determine, I happen to be on the long put tab, but the same reasoning applies to all of our option trades. When I look at the price on a particular asset, let's say it's $1 on this long put, what we want to do is to adjust implied volatility until this price right here is actually what the market says this price should be, which is in this case $1. And then we come up here, and what we've done is effectively backed into the implied volatility. The price, in effect, determines the implied volatility. That's what the market feels the volatility of this put is trading at. So that's all it means. That's the implied, or the expected, or the guessed, or the market estimate of the volatility. That's because that's the way the put is trading. That's the price it's trading at. So if, for an example, the price of the put was at 97 cents, the implied volatility would be 16.9 or thereabouts with this strike price and this asset price. All right, we'll reset it at $1. The interest rate is the interest rate on borrowed money. Now I have it set at 0.5% annually, and that's minuscule, of course. If it was 10% annually, I'd have to adjust that way on up. Clearly, the Fed funds rate, or the risk-free rate right now, is at 1/4%. It's virtually nothing, but this allows you to adjust the price of the interest of borrowed money, and that ultimately will eventually affect the inputs into the expected price of the option as you move along in time. But it's a very, very small effect, and particularly on the weeklies, it has virtually no impact to amount to much, so we're not going to worry about it at this time. The strike price of an asset is, of course, what strike you're going to pick. So I'm reverse highlighting here, and you should be able to see the yellow cursor. That's basically saying, all right, fine, that's we're going to play, let's say we want an at-the-money put, so we'd adjust this to 179, and now you can see the price, of course, is adjusted by the strike. So if that price was, say, $1.50 in the market, we'd adjust the implied volatility until the first sell right in here said $1.50, and away we go. Interestingly, all of these things have names, and we so far haven't covered the part 2, what I call historical or actual volatility. So in option trading, we have what they call the Greeks, which you can read about in any decent textbook on options. And the Greeks effectively are just, for lack of a better term, the rate of change of an option price based upon a certain factor. Delta, for an example. Delta means the rate of change in price of an option given the change in the price of the underlying asset. So if you start out at $179 and generally speaking, what will happen is if you play an at-the-money strike, your delta will be 50%, 0.50. The reason for that, quite easily, is that you got a 50-50 chance of going up or down. In fact, way over here, and I don't really want to spend a lot of time on it, but all the deltas are calculated for all of these calls, puts at this particular strike. You can see the call delta is 0.506. So about 50%. I'm going to make this just a tad larger so you get an idea. I'll expand the size of the... Don't worry about, please don't pay any attention to any of the other data that you see here. That's all superfluous to our discussion. In fact, let's go ahead and just use this very quickly because I don't want to run out of time, but there's a lot of good information right here. The gamma is the speed of the delta. What that means is what's the rate of change of the delta given the speed of the movement, the speed of the stock price. So gamma is how fast the delta moves. Vega is the volatility. How fast does the option price change given a change in volatility? Theta is how fast does the asset price change given a passage of time. And finally, the rho is how fast does the option price change given a change in the interest rate. So as I mentioned to you, very minuscule. You'll notice that the delta at 0.50, 50%. In other words, what this says is that if the asset moves up by $1, the option price will move up by 50% of that. And from there, all of the calculations will have to be redone. The gamma is saying that for every 1% increase in the price of the asset, the delta will move by about 20. The delta will actually move up, so it's the speed of the delta. Vega gives you the rate of change. For every 1% increase in volatility, the option price will increase by about almost 1% itself, or 8%, I should say. Theta means for each passage of time, the asset price will move downward without holding all else constant. And you can see the rho has the smallest change. Given a change in interest rate prices, the option price will move up by 1%. So 50%, 21%, about 8.5%. Theta is about 7%, and the rho, which is interest, is 1%. The delta on the puts are right here, and they're approximately the same. You can see that give or take a little bit. So this is not a class on the Greeks. But what I'm trying to point out to you is that the delta obviously has the biggest impact on an option. And that makes perfect sense. If the asset moves up or down one way or the other, that's called a movement in your delta. The gamma has a big impact on the delta, not so much on the asset price itself, but the gamma changes the delta. The vega has, for example, a 1% move in the volatility will cause appears to be about an 8% move in the option price. And for theta, what you're looking at is theta is just going to effectively dissipate as you get closer and closer to dissipation. All right, so that's a very brief lesson. And in future classes, I may actually go over the Greeks in great detail. A lot of people use the Greeks for heavy-duty trading. But what we want to focus on in this lesson is what do we put in for this volatility, where I've got it set. How do I come up with a number for actual volatility in the future? How do I know? What can I guess? What has it been? That's the purpose of this lesson. So I'm going to close this spreadsheet down. And again, we're focusing on what do we put in for actual volatility. Because as we change the actual volatility, it's not going to change the first cell, but it sure the devil is going to change where the ending cell winds up. Now, one of the best places to take a good look or guess at is the history. And let me show you that right now. I have on this chart that you're seeing right in front of you, and the data is in back of the chart. I'm not going to show you all the data. We simply don't have time to get all into it. But we have 20 years. I'm wondering why the header doesn't show. Oh, there it is. Okay. This is 20 years of 20-day moving average actual volatility from 1993 to 2013. So 20 years and fairly current. This is current as of December the 13th, 2013. And you can see just by looking, if you'll just kind of follow my yellow cursor, you can see the volatility seems to hug from 1993 through 1997 in about the 10 to 15% range, sometimes going down as low as 5 or 6%. As we get toward the turn of the century, the millennium, in fact, two big spikes in here, and I'd have to really look back at the events, but I suspect these were the budget fights between Bill Clinton, president, and Newt Gingrich in '96, and so on and so forth. You see some big short-term spikes going up to 40, 45%. The tech bubble at the turn of the century led to some good volatility spikes. The beginning of the Iraq War in '03 led to some good volatility spikes. Then from '04, '05, '06, '07, you can see volatility was in a pretty confined range, although week to week it probably didn't seem that much. Now, as we close in on the financial crisis of 2008, 2009, you can see one of the wildest spikes upward in, this is the financial crisis of September back in the '08, '09 financial crisis, and you can see volatility spiked all the way up over 90%. So option prices would have gone up dramatically, and of course the stock market was coming way on down. Usually volatility will increase during strong market crashes and will tend to decrease with a slow increase in the asset price. So in other words, if the asset's going up at the rate of 1% per month or 12% annually, the volatility will be very low. When you have a giant crash like we had back in '08, which came to an end in March of '09, you're going to see large volatile spikes. When the market went from approximately whatever it was, I don't remember the exact number, but the Dow was at 13,000, coming all the way down to 6,500 in March of '09. Well, this is that large spike. And now since '09, we have seen some increased volatility, except for perhaps the last couple of years where the market's been a little bit more tamed due to the Fed quantitative easing. All right, what does this tell us? Well, that tells us the history. If we try to draw some data out of this, we'll see the mean of all of that chart is all this data. This is 20 years of 20-day moving average. So taking the past 20 days and looking at the average volatility, it appears to be about 16.39% with a standard deviation of about 10%, which means most of the time this volatility will be between 6 and 26. 16 minus 10 plus 16 plus 10. So about 6 to 26, but now that's a really wide range. And you can see that right here. The range is, on all this data, is 89%, all the way from 5 up to the high of 94, which would have been right in here. And this is a count of 5,419 days. A long time. So, I mean, it's 20 years of market trading data. So if nothing else, we've got an idea, correct? But how do we tell for right now? How do we say, well, it's going to be right now? Well, numerous studies, and I'll get into that in more detail in part 2 of this session, would be, there's a number of ways. Let's put it that way. In the book, I spell out to you that we can certainly use moving averages. So Crystal Ball, for an example, has a fine tool that allows us to compute time series analysis, which is something we could go into more detail later on. For an example, let me move this chart. Let me move this chart off to one side. And if I took the last 20 days of actual volatility, bear with me while I get myself oriented here. This date, I'm trying to show you the date. This date is December 13th, 2013. If I took the 20-day volatility and I said, well, all right, what has it been for the last 20 days? So if we go back to about 47 minus 20 would be, 27. So if I go to 27 and I say, geez, what is this going to look like if I did a time series analysis? Well, I can use Crystal Ball to help me with that. So let's take a look at what a time series analysis would look like. And I'm not showing you the details. I'm just going to run it and we'll take a quick look at it. All right, there's 20 days of data. You can see the past is here. The blue line means the fitted to the data. The green is the actual historical. And then we've got, in fact, I'm going to shorten this up a bit. I'm going to shorten it up to the next 7 days only. A time series analysis is telling you that, all right, the volatility has been as high as 9%, dropped down to 7%, and a time series analysis is predicting it to come in at about, over the next 7 days, at about 8%. The little red lines here indicate error messages of plus or minus, it looks like about a 0.5% to 0.75%. So on a time series analysis over the next 7 or 8 days, you might be very, very sensible to predict that I think volatility is going to be at about 8 to 8.5%. That's using, again, time series analysis. I'm not trying to overwhelm you in this session, but you have to come up with something. All right, I'm scrolling down. Another way, go to any of your websites, or for an example, I happen to love Yahoo Finance, www.finance.yahoo.com. And if we go there, and you may already know where I'm going with this, but if you don't, one of the best ways of looking at where the market thinks the volatility is to look at the VIX, VIX. Currently, the VIX is running at 15.76. I will get into numerous studies later on, and if we looked at where's the volatility been for the last month, Yahoo Finance will pick up a chart for us. And we can see that volatility, as measured by the VIX, has been anywhere from a low of 12, been on the increase, came back down during December 9th, and now has increased dramatically because the market came down. And the reason for that was due to fear of tapering here in late December of 2013 by the Fed. The Fed has been doing the quantitative easing program at a rate of $85 billion a month, and now the market's a little afraid that it may taper here soon due to good economic indicators. So the volatility has raised to 15 and 3/4. A good rule of thumb is that generally speaking, short-term actual volatility should range somewhere between 70 to 80%. These are all rules of thumb, so please don't go off and saying that I told you this is an absolute truth, because I'm not saying that at all. And any trading you do is solely up to you. It's your responsibility. I'm trying to teach you about options here, not tell you how to trade. So if I multiply that times 70%, I get about 11%. And that may be a good indication of the next 5 to 7 days volatility. About 11%. They're about 70% of the VIX. 80% would be, bear with me, 80% would say to you about 12.5%. So a good thought might be to look at, well, on the 20-day, maybe I should look at about 11% volatility. That's going to be a judgment that you're going to have to use, frankly, yourself. It's going to be your judgment as to what you want to do. Now, that goes back once more to our input for sell right here, where it says historical volatility. So if you want to raise this to 11%, by all means do it. However, just remember or keep in mind that what that's going to do is to spread out your standard deviations as computed in here. So if you'll go back and re-look, what you'll see is that as I lower the standard deviations, or the historical volatility, to 10%, you'll notice that the standard deviation amounts above where I'm playing with the cursor. It's a little hard to see. I got yellow on yellow here. But you'll see those numbers changing. And then they start getting wider and wider the further that you push that historical volatility. So my only point is that somehow we have to come up with our best estimate, and that will give us the real trade. And VIX is certainly the market way of interpreting that. All right, now the essence of the lesson is really back to this sheet, which is available to you on your website under resources. And this is this sheet is again available to you. And this, assuming that you're able to compute the actual volatility, this sheet, making it a little larger for you and getting some confusing looking data. But what I want to do is explain this sheet. This goes back from 1993, and in the book's case, I've updated the data now for another year, but you had 19 years of data here, almost 20 years. And what this is telling you is MOFC means Monday open, Friday close, and the first column is iron condor. The second column is bull spread, and I'm going to call it a bull put spread, credit spread. And this is a bear call spread. Bear call spread, a credit spread. This applies to credit spreads for my purposes. And what this is telling me, let me show you how to read these matrices. If you went in the market and had correctly calculated the historical volatility, all the rest of them are easy except for possibly the annual rate of return up or down. If you correctly calculated the standard deviation using that historical volatility, once again, or if you just used a very, very good surrogate, and if you would have predicted with perfect accuracy, what this is telling you is that if you use an iron condor, which would be selling a credit put spread and a credit call spread, that's the combination of the two, and you were 1.8 standard deviations under on the short strike and over on the short strike, you would have had a 94.4% winning rate over all of that time frame. And I've computed that from, wait till you see this. This is, I call the truly amazing spreadsheet. It's, first of all, enormous. It took me months to, you can just see by its how big this thing is. I've set up weekly spread trades, and I've had interns assist me in inputting all the data over. Suffice it to say, this thing is gigantic. It's right now it's running at 5,500 rows. It's just enormous, but it allows me to bear with me while I get back into it here. Right, just take a moment. It allows me to calculate every single week over the past 20 years what happened. We call this the amazing spreadsheet. We allude to it in the book. So far, over the past 20 years, I'm looking at 1,085 weeks of data. All right, back to what our little, this sheet is the summary or cheat sheet, if you will, for all of that data. That's where I've gotten it from. So I'm telling you, you can pick your own, I'm not guaranteeing anything, but I'm telling you what the data have shown. And so if you traded it one standard deviation away on an iron condor, a 5 opening on Monday and closing it on Friday, you should have about a 70% chance of winning. To break even, you'd need to sell it for a total of 23 cents, and to get hopefully an annualized win rate of 100% annually, you'd have to actually get 25 cents on the trade. That's not always possible. A bull, or just a credit put spread, a bull put spread, let's go, that's what purpose of the book, the 1.8 standard deviation inflection point, is if I go under the asset price by 1.8 standard deviations on Monday morning at open, with my short strike at 1.8 standard deviations away, I should win about 97% of the time. My break even would be 30, and my 100% win rate would be I'd need to make 5% on the trade. So if I traded 10 calls, I'd need to make 5 cents. My risk would be 95 cents. So it's a risky trade, very risky. But is it, with the probability as high as it is? Now that's something each trader has to judge for himself or herself. And then on the call side, with a Monday open, Friday close at 1.8, you can see you've also got a 97% chance of winning with a slightly lesser break even and 100% win rate. The MCFC means Monday close, Friday close. In other words, if you in theory traded right before close on Monday, and then your cheat sheet shows you Tuesday open, Friday close, Tuesday close, Friday close, Wednesday open, Friday close, Wednesday close, Friday close, and so forth, until finally, and this one might be a little confusing for you, this stands for Friday close, Friday close. Well, how can you do that? That means if you made the trade on the Friday previous to the subsequent Friday. In other words, if today was Friday the 13th, this means I'd be putting down a trade that would close on Friday the 20th. And these are trades I've grown to like very much. You're actually in over the weekend, which is usually a little scary to many people. But in some ways, you're getting some free theta. In other words, Saturday and Sunday is time lapping as well. And I've been looking at recently the bull put spreads on Friday afternoon, waiting 7 whole days at about 1.6 SDs, which gives me a 97% win rate. And I found some favorable pricing that'll get me 5 and sometimes even 6 cents. Sometimes you will not get filled because the market is smart. I believe that the market is trading with these same probabilities in mind, but us little guys, us retail traders, do not have the access to all of this data that the market has. So the market's already building in off these probabilities. But the question gets to be is, well, how are we going to use them? For example, on the bear call side, I generally will not go in on a Friday before a subsequent Friday with a bear call. I can't find the pricing. Usually the pricing is not as high as I need it. So I'll put in limit orders, and if it does come up and hit my trade, then I'll take it. If not, I will not. But generally speaking, this sheet, which you have access to under the Resources tab on the website, third link down where it'll say break even and win annual statistics. You can save this spreadsheet and this print it out. This is your spreadsheet that I use this all the time as a cheat sheet. In other words, and one last time before I close out this section, on Monday morning, right here, if I wanted to go in and if I could find a bull put spread, so if the market was at 180 and one standard deviation was $3, I could go about two standard deviations, it'd be $6, 1.8 standard deviations, it'd be about $5. So I'd go in with a 174, 175 bull put with the market at 180. And if I could get 55 cents for it, 5%, and I could trade either 10 spreads or 100 spreads or whatever I'm going to trade, I'm telling you that I feel fairly comfortable in saying that if I get 5% for it, I've got a 97% chance of winning that trade. And that's covered in detail in the book. All right, I'm going to close this. This is a complex section. I've already run past my 30 minutes. But what I'm going to do is to continue. I'm going to do one more section on interpretation of this data so that you get a good idea of what I mean, and keeping in mind that the trading style that we're dealing with is incredibly dependent on this number where it says his input master historical volatility. This number is critically important because you can see that what it's going to do is change that standard deviation point, either narrowing it up or widening it out. And if we can calculate this correctly, we are actually determining proper pricing for the spreads. Regrettably, the best that we have for us is either time series analysis, best guesses. The VIX, of course, gives us a good idea of what the market is saying, because the VIX is the implied volatility of the at-the-money options on the S&P 500, and it's called the fear index. But I have found that actual volatility appears to be about somewhere between 70 to 80% of this in reality. In other words, the options trade a bit higher than actual volatility. On the other hand, there's no guarantees in this business. The VIX can be at 15 today, and the market, as a volatility, could spike to 20. I mean, for all I know, if there's an unforeseen action, who knows what it'll be. So at any rate, please take a look at your, I'll call it the 1.8 standard deviation cheat sheet, and start getting used to knowing how to read it. So I'll close out for now, and we'll be back covering one more section of interpreting actual volatility in the next session. All right, thank you. This is Charles for the 1.8 vertical option spreads, the 1.8 standard deviation deflection point.